Hey all, welcome to ShareTreck. It's the 17th of July 2022. A beautiful Sunday out here. I hope you guys are having a great weekend. I did have a good time yesterday, went out for brunch and all that. So I'm fully charged. And I spent some time yesterday looking at various opinions and also news articles, economic updates, and everything. I formulated some new ideas, which I think kind of explains how the market is reacting and can give us a clue on what's going to happen next. I would like to share that with you today. So let's get started. Hey all, today's video is an editorial opinion on the state of the investment environment and the genomics capital scene. On Friday, we saw that the markets were improving. While we have seen sustained weakness in oil prices, with more than one data point showing oil below $100, the Friday spike in stock prices were attributed to the lower prices and lower oil prices and its anticipated cooling of inflation. So as the oil prices go down, it's going to percolate into reducing the cost of everything, right from transportation to manufacturing and everywhere. Even energy prices like the electricity that we use, those prices can be moderated because of lower oil prices. And therefore, the markets, I think, felt that inflation is going to come down. And I have been thinking about this for the last 30 days. As I mentioned, in fact, I expected the inflation report that recently came up to show a moderation because of the low oil prices. But it is sure that in the coming CPI report, the next one, we'll definitely see that. And in anticipation of that, the markets have been improving. And that's my thought. That's what I think could explain why we had a spike on Friday. Consumer spending is still strong, and spending has come in pretty strong in the recent report, indicating that the inflation is more demand-driven. That means the economy itself is strong and is capable of taking a lot more interest rate hikes. So we need to realize that the interest rate hikes will definitely happen. But because of the fact that the lower oil prices are expected to temper inflation, while consumer demand will keep the economy strong and put a lid on unemployment, that's the kind of outcome I think that we are looking at. But there is more nuance to this. This kind of a situation makes some economists feel that a 100 basis point hike is not warranted. The more the rate hike, the stronger the US dollar, and that will result in cheaper imports, but an increase in unemployment. Because if the import becomes cheaper, then local manufacturing will suffer because their margins will go away and their demand will go away because of the high price. And in order to cut the prices, they will have to reduce the production and remove some employees and do some kind of jugglery like that. So I agree that with these economists that we probably don't need a 100 basis point hike going forward. It should be a 75 basis point, but we'll have to watch what the Fed does. The job of the Fed is a very difficult one. So let us look at the Federal Reserve's perspective. As per the Fed, we should expect the Brent crude oil price will average around $101 per barrel during the rest of this year. This is what I got when I looked at their reports. And at the end of this year, they are expecting it to go down. And in 2023, they're expecting it to be around $94 a barrel. That doesn't mean it's going to be 101 per barrel for throughout the rest of the year. It just means that the average will be around 101. So we may go down to 95, go up to 110. But overall, we are going to stay on an average of 101 for the rest of this year. That is the expectation. And for next year, it's expected that we'll be averaging around $94 per barrel for 2023. This means oil-related inflation will flatten. The forecast oil price declines are the result of expected increase in global oil inventories in the late 2022. Most of the price declines in the Fed forecast occur in the rest of 2022, while falling to almost $97 per barrel on an average in Q4 2022. So if that is going to be the trajectory, that oil is going to be stable and go down further at the current levels, then I think it's going to have a very good moderating influence on the inflation and the economy inherently being strong and the unemployment being very low at around 3.5%. we should be doing well. So if the Fed was to hike the interest rate too much, then it could probably lead to strengthening of the US dollar and cause problems for us in terms of the unemployment number. So if the economy is strong and consumer continues to spend strongly while gas prices stay around $100, it will lead to good stock prices. However, this can restart inflation. So the Fed has to be very alert and it has to continue its balance sheet shrinking. That's my opinion. Even though they may not do 100 basis point hikes, but I think that they should continue their work on reducing the bond purchases and moderate around the mortgage-backed securities, not start selling mortgage-backed securities, but moderate the mortgage-backed securities renewals. And if they do that, I think they would be taking their foot off the accelerator on the interest rates. And this is going to look better for the whole economy, and the stock markets will respond accordingly. So more tempered interest rate hikes will also allow housing markets to attempt a softer descent to equilibrium, because right now not only the US housing market but also Canadian housing market both are under stress, and any increase in the interest rate is going to lead to increase in mortgages, and that's going to lead to a problem selling homes. Home values might fall, so it can lead to mortgage delinquencies, and it can also lead to people not being able to move from rental to their own home. Therefore, the rental stock will become less, and rents will start consuming a bigger part of the consumer's paycheck, and that would mean softening demand. So all these factors have got to be balanced. That's where I'm coming from when I say that instead of 100 basis point hike, let's go for 75 basis point hike, while continuing to reduce the bond purchases and thereby taking out liquidity from the market in a much more moderate pace. Now let us look at how the overall environment has been for our genomics ecosystem, because that's where our interests lie as a genomics channel. So after peaking in 2021, venture funding to biotech startups slowed down in 2022. That's what the evidence shows at this point of time, with investment on pace to come in at least a third lower than the last year's levels. So we are going to lose around 33% in terms of investment made into genomic sector by venture capitalists as compared to last year. In the US, the biotech startups have raised a total of around 16 billion so far this year, or about 3.2 billion average per month. However, if you were to look at what happened in 2021, nearly $47 billion were invested by venture capitalists in the biotech space in 2021, which averages to around 4 billion per month. So as you can see, there has been a drop of a significant amount of investment in genomics sector, and that's understandable given the tight monetary situation and the risk of environment that we face. But still, this is a pretty decent investment in my opinion. Now, just to give context, it's not like companies have become anemic in terms of getting money, but I think venture capitalists have been more selective in investing in companies. So the quantum of investment is still looking pretty good. I'll give you some examples of startup companies and how much venture finance that they have raised this year. Basically, because we always look at our watch list of stocks, we don't look at startups that much. If we do look at startups, we are more focused on what's the new technology they're coming up with. That's about what we do. That's why it's going to be more important for us to look at the quantum of money that's going from private venture capitalists into genomic startups. Let's take the case of Resilience, a provider of biomanufacturing technology for producing complex medicines, and it raised $625 million in Series D funding recently. There's another company I would like to mention. It's called Ultima Genomics. It's a developer of low-cost sequencing platform for delivering genome readings in the $100 range. And somewhere around May, they said that they have secured around $600 million in backing. So that's, again, a very healthy amount of investment. Another company is Econ Therapeutics, that is EIKON, Econ Therapeutics, which develops applications to apply liver cell super resolution microscopy to drug discovery. It announced in January that it raised $518 million in Series B funding. So if you see that in the biotech sector and also in genomics, the inflow of funding has been there, and it has been at decent levels for companies, but probably not as many genomic startups got funding as would have expected. That accounts for the slightly lower average fundraising per month as compared to the previous year. Now, if you were to look at Illumina Accelerator, it has invested in 68 startup companies so far, all of them developing genomic technologies. So in summary, I would say that we are in a difficult stretch, like walking on a tightrope over two skyscrapers. So imagine the scenario. You've got a rope which has been tied between two skyscrapers. Below is a depth. You can see the traffic going below at a horrendous depth. When you look down, you may feel dizzy, and there is the wind blowing around, and you've got a stick in your hand to balance yourself, and you're walking along. That's how it is. It seems to me to be for the Fed. The Fed has to be very alert and not stress the system too much, and it can't let up too much, because then the inflation will rear up again. I think will depend on how some of our risks unwind, and the Fed will have to react accordingly, because as the risk unwind, the stock market will start going up, and also we'll see the inflation rearing up again, because demand will go up again. So, for example, I still think that if Russia-Ukraine war ends before December, we should be fine. That will throw another catalyst into the mix, and Fed will have to react accordingly. Let us say if the Iran deal is signed and more oil comes into the market, then that's also another aspect that the Fed will have to consider. And if both of these happen simultaneously, then there is going to be a sudden glut of oil in the market, because the Iranians are going to be very keen to sell as much oil as possible and pump money into their economy. So the oil prices can go down much more faster and much more deeper. So all these things are there. I think the Fed has got a tough job in front of it. Now, all said and done, a year down the line, genomic stocks would not be available at the bargain prices that they're available right now. That is my personal opinion. I think that if you were to ask me a question whether we have reached the bottom, I don't have an answer, but I suspect that we are already at the bottom. But the bottom doesn't mean that we are going to be a steady line. We are going to move up and down in a consolidation range until we get absolutely good cues to start moving upward. And when is that going to happen? No, we don't know. We'll have to keep on taking in all the information that comes in on an ongoing basis, and then we'll be able to make a decision. So we have to keep on deferring the decision about when the bull market will start while we wait for more information to unfold and as we wait for time to pass. So that's how I see the overall market. So to summarize everything, what I would say is that the economy is getting a bit of a relief due to the lower oil prices. They didn't feed in into the CPI result that we recently got, but they will definitely fill in into the CPI results that we are going to get in future. In anticipation of that, and therefore the Fed being less hawkish and going for a 75 basis point hike rather than 100 basis point hike, I think the markets started jumping up on Friday. And if the sentiment continues, we'll see consolidation sideways in the market. And potentially in the fourth quarter, we may probably see the foundation for a bull market emerging. That's my opinion. Now, with that said, I would like to quickly thank our subscribers. Some of you have decided to jump the fence and decided to subscribe, and you have taken us up in numbers. So thank you so much for all the new subscribers. And also thanks to the old subscribers for sticking with me until I keep on experimenting with the patterns and everything of this video and the channel, and try to bring something much more stable and better quality. Thanks for your inputs also. Some of the subscribers have given me some feedback. You can see that in the screen today. We have a different screen, and we have a different layout. And also, I think as I keep on making more and more videos, it's definitely going to improve. So hang in there and give me a little more time, and this channel is going to get better and better. With that said, I'm also doing a bit of programming change, again, based on feedback and some discussion with some of the subscribers. What I'm going to do is in the morning, instead of doing NASDAQ and genomics technical analysis, I'm going to reduce that content significantly. Instead, I'm going to focus on the news items, sentiments, and happenings in the market. That's what is going to be the morning show. And then around 3:30 every day, I'm going to be, every day means every trading day, I'm going to be on a live stream with you guys here. And we'll watch the market close for 30 minutes, during which we can have free exchange of conversation. You can ask me questions and I'll share my ideas. And then when the market closes at 4 o'clock, I'm going to start reviewing all the genomic stocks and also NASDAQ and the indices with an idea of projecting what's going to happen the next day. So this is what I plan to do. If you have any concerns with this new format, please don't hesitate to put it in the comments, and I'll definitely respond to you on that and make necessary changes. But this is what many of the subscribers who have spoken to me seem to be thinking about. And I also think it's a logical approach to take. This will kind of refresh our channel, give us a fresh impetus out here. And with that said, I would like to bring this video to an end. If you did like the video, please press like out there. It helps YouTube promote our video to new viewers and help them discover our channel. And if you are not yet subscribed, please subscribe and help us grow this community. Thanks and have a great day. Bye for now.